Do you agree, Michael, with Mnuchin as well as Goldman Sachs that we're seeing symmetric risk when it comes to tax reform?
I think it comes down to how much tax reform we're able to actually to enact. So I think the market's discounting that something will get done, but not a lot in our view. So if there was if something does get done, I'd agree that there's upside there. If we don't make much progress, I think the market may well shift to focusing on underlying earnings growth and fundamentals. I don't think it would be a huge surprise to see more inaction out of Washington, really.
So, Shahab, if I was talking to Mnuchin, I would say, hey, but look at the dollar and look at the 10-year yield. Those two things don't necessarily tell me that there's a lot baked in when it comes to tax reform. What would you say?
No, I would agree with that. At the end of the day, if we go back to where we were, let's say, in December last year, when Trumpflation hopes were at their peak, you had dollar-yen at 118, for example. Right now, we're getting close to 113, but still some way off those highs, despite the fact that actually economic growth around the world is strong, which tends to be something that benefits dollar-yen anyway under normal circumstances.
Yeah. Michael, what do you make of the strategy at this point? It's not the first time we've seen this strategy. President Obama, I remember with the debt ceiling negotiations and the issues he had there, went out there and said the market should be concerned. The markets weren't concerned. The idea being that he wanted to put pressure on lawmakers to actually do something. Is that what we're seeing with this administration? Not just tying the success of their policies to the market, but trying to use the market somehow to put pressure on others?
Maybe that's a strategy. I go back to, it's so hard, I think, for investors to try to handicap what's going to come out of Washington. And frankly, there's been this wall of worry that we've faced for quite a while now, the better part of the year, and the market has overlooked that and really looked at double-digit earnings growth, solid economic global GDP growth, decent momentum of GDP growth, and that's against a backdrop of really low rates and expectations that rates are going to be really low into the future. And yeah. I think the punchline is that there's been so much crowding into lower quality pockets of fixed income. There's been a lot of yield chasing that I think the next step down the capital stack is into equities. I think that's part of the reason that we've had this melt up. It's a scarcity. There's just not a lot of other assets that are attractive to buy.